You are listening to Keystone's Stock Talk Show, episode 296.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week. I will kick off the show with a review of star retail holding Aritzia Inc, symbol ATZ on the TSX. Shares surged 18% last week on better than expected fiscal year Q4 2025 numbers and strong fiscal year 2026 guidance, despite the volatile environment. Aaron, reports on income stock holding Parkland Corporation, symbol PKI on the TSX, the fuel distributor and retailer, which announced it will be acquired by Sunoco LP in a transaction valued at $9.1 billion. In our Your Stock, Our Take segment, Brennan answers viewer question and updates Atlas Engineering Products, symbol AEP on the TSX Venture, a Canadian microcap which designs, manufactures, and sells engineered roof trusses, floor trusses, and wall panels. The stock is down 42% on the year. Brennan lets you know if it is an opportunity. Finally, Brett tackles the impact of Trump tariffs, how they are currently reverberating through the U.S. economy, and what we can expect in the near future. All right, let's get to the show. I welcome my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing? Have a good weekend.
Doing well.
Yeah,
you
pretty
betcha.
good weekend.
Doing good.
Yeah.
I was back on the course,
yourself?
which was nice.
Back on the course, eh?
Yeah.
I heard you got sunburned.
Yeah, I got a little sunburned. If you saw
Uh-oh.
my arms, yeah.
Was that
Is
your
it the farmer's
state
tan
for
or?
the
It's-
performance that day?
I mean, the performance was all right, but
Yeah.
You also had somebody walk off. Or
yeah,
should we
we were.
not get into that?
Oh, that's fine. It's
Frustration.
Fine. So we're golfing at a really nice golf course, and one of the guys, like, we went out with as a foursome, and one of the guys, he just couldn't, make good contact with the ball. So by the third hole, he's just like, "Okay, see you guys," and just walked off the course.
Yeah.
Yeah, and he said that he was going straight to the clubhouse and booking a lesson. I don't know if he did, but yeah, glad to
Or
be
lesson
doing
for
that.
that day or for
Probably
a different day?
Picking
I think
up
a different
beer.
day probably, but maybe
Yeah.
a beer too. But yeah.
Well, we did get some news. Warren Buffett announced at the Berkshire Hathaway meeting on Friday, their 2025 annual meeting, that he is going to step down at the end of this year. He did not tell anybody other than, I think, his two kids going in. So it was a bit of a surprise. I believe, this time last year, he said he had no plans at retirement. So a bit of a surprise there. Hopefully it's not a health issue. But Vice Chairman Greg Abel, who I believe is Canadian, we're at least claiming him as Canadian, is taking over. He has been the successor, kind of waiting in the wings, designated heir since about 2021. But he was kind of unaware of the exact timing until the kind of surprise announcement at the meeting. I'm sure, mixed emotions. I'm sure he loves working beside Warren. I understand that Warren will still be involved. So I think the market probably didn't panic this week to start off. But it is interesting news for a man who has been like a beacon for the free markets, for investing for about 60 plus years, stepping away. So interesting news. I mean, we follow his research. We use his analysis and his philosophy to really leave no stone unturned. So, it'd be an end of an era at the end of this year.
Certainly. I mean, it's just like you think, what an icon, in the investment industry for decades. It's multi-generational and strong performance right up until, the end of his career. So but 94 years old. So he's 94 years old. It's amazing that he's still, I mean, and you hear him, I mean, he's doing interviews, like he sounds great, but you never know. A lot of times I think maybe he just figured, take the time that he has and spend it with his family, and whatever it is, I hope that he's able to get some good time.
Yeah, no, I mean, just an absolute somebody, also a guy who you never hear in the news for any scandal or anything like
No,
that. Just
never.
like
I think
completely,
it sounds like he lives kind of a boring life in terms of what most people would, he goes to
yeah,
work, he does his job, he's got his family, and I don't think he thinks it's boring. I think that he
yeah,
thinks it's great, but it's not, he's not out at the clubs, he's not out showboating and standing in front of the media and trying to get attention for himself for various things, right? He's just always was so very focused on what his job was, which was, as he said, capital allocation, and
yeah,
finding
and
great companies.
lives in the same home basically that he
Mhm.
has for
Oh yeah.
forever, and driving like similar cars, and just all of that, and giving his primary wealth away to a charity soon as well.
Mhm.
So, I mean, quite the life, and there'll be books written. There already has been tons of books written, but just on probably the way he, obviously his investment philosophies, how they've changed the investing for many people, but also probably just on how he conducted himself and his quips. There's millions and millions of quips from Warren. Wisdom for life, and then wisdom for the financial arena as well. Books on him, if well done, are worth the read, because he's,
Oh yeah. Yeah.
and
Because
although he
JP
led,
never wrote one himself,
no,
right?
oh, you want,
Um,
I mean, he has every year they write like
the annual
the
general or
annual general meeting. You can put
yeah.
those into, they become a book basically unto themselves.
Yeah.
Yeah.
And people have used it for decades as a instruction manual or
Yeah.
you know, timeless knowledge.
One thing that I'd like to say is, like, I listened to some of the meeting, and one of the questions posed was just like, why are you building so much cash right now? Is it just generally because like the markets are overvalued? And then, you're cautious. They even joked kind of at the end of the question, or are you just, stockpiling capital for Greg Abel to deploy, so he can look good, kind of by deploying the capital going forward here. But
The thing is, you
Warren,
look poor if you do it in the wrong places.
well,
So it could be
exactly,
setting himself
exactly.
up for failure. It
Um,
depends on what. I, I,
and
yeah.
Warren just kind of jokes and being like, no, I wouldn't do that. And he's just, he even says in his answer, he's just like, we just tried to deploy, 10 billion recently. So, in any market, he's basically saying like, we would like to deploy, this kind of capital as long as we can find the opportunities. So, maybe the growing capital or cash balance is just because, valuations are pricier on the overall market and it's harder, to deploy. But he still wants to deploy.
Yeah,
He said when the opportunities arise, they will.
for sure. I
Very
mean,
few
but
opportunities for him, just even in any market,
Exactly.
because he needs to buy
Yeah.
big companies.
we said at the start of this year and even ending last year, markets were historically and still remain at the higher end, but historically cheap. And it's pretty natural for a guy who's looking at growth at a reasonable price, when he doesn't find it, to have more cash to deploy. And you see when markets are at historical high valuation wise, he has more cash. It's smart, in my opinion. So.
Yep.
All right. Should we look at the poll question? Brett, you've got that. Do you consider yourself a long-term investor? Was the poll question, I believe.
Yeah, so it actually, I would say, really fits in with Warren Buffett philosophy, being a long-term investor. So just asking around, it's a pretty simple question, but 62% of our viewers said yes, they're a long-term investor. 29% depends on the asset or stock, and 10% say they are a short-term trader, or at least focus on that.
Yeah, I mean, I would say, just saying, do you consider yourself a long-term investor? I mean, investor, to me, even the word, you should be long-term. It's either trader versus investor. And, it is nice to see that the people that are listening to our podcast are long-term investors, because, I mean, that for us is the only way to actually invest in the market. Trading.
Not sure why traders would
money.
listen to our podcast. So yeah, I mean, no surprise to me. Most of our viewers would be on the long-term side.
And I voted investor. I'm just
really, I'm shocked, but
I know, strange.
That is just surprising. But I actually do like to listen to like some trading stuff occasionally, just because it's so polar opposite to what we do. Most of the time, I honestly don't gain much from it. But it is always interesting. There'll be, especially something like a macro trader, that stuff I find, even though we don't do any of that,
it can be
a bit more
interesting to hear
interesting, at
their
least.
opinion.
Applicable, probably not for our work, but it can be at least interesting.
For sure.
Yeah,
All
for
right.
sure. Like one thing that I'd just like to add too is, yeah, it depends on the asset for me. And like, you know, I have done, like, when all of a sudden interest rates, you know, were going up, I, you know, made a little short bond trade, you know, so like there's like things that I'll do in my portfolio. But again, it's that it needs to be a small piece of your portfolio. You're gambling, you know, even though you can make like a macroeconomic kind of like, you know, outlook. Who knows? You know, you're good. You're probably going to be wrong, but I did actually vote. Depends on the asset. Even though, you know, 95%, even more probably, of my positions in my portfolio are, you know, holding quality businesses for the long term.
Yeah.
Anyways,
I mean, you've been trading Pokemon cards for years too, right?
I love that you call him
Short term.
Pokemon. That's like my dad.
Pokemon.
Yeah. But
you're,
no,
you're a bit of a Pokemon.
I don't own any Pokemon cards. I'd have to go and ask my mother if she's got some binder packed away. I do have some old trading cards, though, hockey trading cards. Yeah.
Nice.
Yeah.
Who's the star holding in that portfolio?
I have no idea, but here's the issue with that. Here's the issue with that is I actually inherited it from my dad. So it's like, you know, got the Whalers in it and, you know, the North Stars, et cetera, et cetera. So, you know, it's from before my time, but maybe one day it'll be worth some money. We'll see.
Awesome. All right. We might as well move on to we're going to look at our star of the week, and I'm going to share. Okay, and our star of the week should be no stranger to our Canadian small cap clients. So that company is Aritzia Inc., symbol ATZ on the TSX, trades around $56, $6.4 billion market cap. But what does Aritzia do? They were founded in 1984 by the Hill family. Aritzia is a long-term growth-oriented, innovative design house and fashion retailer with exclusive brands targeting primarily towards the women in the range of 15 to 25 range. Aritzia operates 130 stores across Canada and the US, in addition to an established e-commerce platform. Aritzia is a strong niche player in the fragmented industry. It differentiates itself through integrated model encompassing conception, creation, distribution, and direct-to-consumer retailing. Why is Aritzia our star of the week? Well, this is just over the past week, an 18% jump last week. I will get into what drove the jump in a second. But I think it's important to put the move in context of what has been a very volatile year for Aritzia and for most retailers generally in the face of a tariff war. This chart shows kind of a circumference way to get to being up about 5.4% this year. Lows in the $38 range to highs in the $73 range. Again, all to end up just up over 5% this year. But that's what you get in an uncertain demand and supply chain environment driven by tariff fears. It's probably also relevant to point out that this is Aritzia's performance over the last 5 years. So extremely strong performance, up 275% over that time, particularly when we witness this performance against a couple of the more well-known and well-publicized Canadian retail names over the past 5 years. One being Lululemon Athletica, great company, but just up 27.6% over the past 5 years. So decent performance, but nothing close to where Aritzia is. And finally, if you look at Canada Goose over that same period, it has been an iconic name in Canadian retail segment. It at one point was a stellar performer. Now, over the past 5 years, it's down over 63%. So at the time, 5 years ago, 6 years ago now that we looked at this company, we also looked at it against Lululemon and against Canada Goose, found it trading at a more reasonable valuation, found a more solid growth path ahead of it, and certainly has been the pick of the litter of those three over the past 5 years. Okay, so let's take a look at the strong fiscal year 2024 Q4 results, which drove Aritzia's share price higher over the past week. Okay, let's take a look at the strong Q4 fiscal year 2025 numbers, which drove Aritzia's share price higher over the past week. Net revenues overall were up 31%. In the US, net revenues were up 48%. Retail net revenues were up 24%, and e-commerce revenues were up 42%. Gross profit margin, which has been a real story for this company over the past year, we're up 420 basis points. Adjusted EBITDA was up 121%, and adjusted net income on a per share basis jumped to 83 cents per share, up from 34 cents in the same period last year. Let's take a quick look at the balance sheet here. Cash of about 285 million, debt of just 3.8 million, lease obligations of 922 million. That's a strong balance sheet. Significant net cash outside of the lease obligations here. Guidance or outlook for the fiscal first quarter of 2026, Aritzia expects revenues of between 24 and 28% up year over year. Gross profit up about 200 basis points. Prior, it was expected to be up 58 basis points. SG&A as a percentage of revenue to be less or minus 100 basis points, roughly where it was prior published, and adjusted EBITDA margin up to 14%. Prior, it looked at about 10.8%. So guidance or outlook for the full fiscal year 2026, revenues around 11 to 19% year over year, which is up over or in the range of consensus. Store openings, a minimum of 12 new boutiques and 5 repositions. That was expected. Adjusted EBITDA between 14 and 15%, right in the range of prior published. And CapEx about 180 million, close to the prior published 182 million. The takeaway here is annual forecasts broadly were unchanged, with better first half of 2026 offset by accelerating gross margin headwinds in the second half as tariffs really could take hold. Now let's look at tariffs, as that was a major question on the company's conference call. Now, management has been very proactive in diversifying the company's manufacturing base in recent years ahead of the tariff situation. Now it is shifting some of its supply chain away from China, which has been hammered with triple-digit tariffs from the US. China is one of the top 3 countries that Aritzia relies on to make its clothing. It's estimated at the start of this year, heading into calendar year, about 50% came from China, but it intends to cut back its production there to 25 to 20% in that range for the upcoming fall winter season. So a significant shift already. Impressively, management estimates its reliance on China will fall even further by this time next spring, when Aritzia predicts just a mid-single-digit percentage of production will happen in China. As part of that diversification, the CEO commented that the business will turn to long-standing partners in the 12 other countries that it operates, like Vietnam and Cambodia, where Aritzia produces clothing. It will also explore new countries and broker relationships with new existing or new suppliers that can improve its existing products. Again, this is an impressive pivot over such a relatively short period of time. So let's take a look at quickly at the valuations here. Based on a trailing basis on actual numbers, just under 30 times adjusted earnings. Based on this year's expected earnings, about 24.8 times, and next year's about 18.6. We'd say there's a high variability in that estimate right now. These are relatively reasonable valuations in a vacuum, but we are not living in a vacuum at present. I'm going to give a quick conclusion here. Fiscal year Q4 2025 results were very strong in terms of revenue, margin improvement, and EPS growth. The company has reasonable valuations in a non-tariff environment or in a vacuum, but again, we're not living in a vacuum. It's almost certain weakness to see creeping in either the current quarter or by the year's end as the consumer pulls back spending in an uncertain environment. It makes this high quality business. Again, it's a high quality business, but it makes us a hold in the near term, given the uncertainty in the second half of this year.
Yeah, and I mean, I guess generally it is nice to hear that, you know, their supply chain is a little bit nimble. You know, compared to if we look at like Canada Goose, for example. Again, when I covered them on the podcast not that long ago, I didn't know. I mean, maybe all of our listeners knew and you guys knew. I know Ryan knew, but I didn't know that, you know, Canada Goose manufactures all of its clothing in Canada. I didn't know that. So, you know, that is one thing that at least, you know, it is nice that Aritzia can be more nimble in just all of this uncertainty.
Yeah, I mean, it's
like a lot of, sorry, I was just going to say, you know, a lot of people, just generally speaking, ask about, you know, what industries are you interested in? What, like, you know, sector categories should we be investing in? And, you know, a lot of the times it doesn't come down to the industry category. And I think that Aritzia is a really good example of that, because typically we've not been positive on the retail space in general, particularly the brick and mortar retail. But even within areas where, you know, the overall industry isn't necessarily attractive to us, there are individual companies with specific niches or growth strategies that we do find attractive. And Aritzia is a good example.
Yeah, I mean, this combines, at the time we recommended it, you know, $16 about 6 years ago. It combines a reasonable valuation at the time, good balance sheet, and just an excellent management team that has had a great brand that they've cultivated over time. And, you know, they don't really close stores. They just open new stores, but they don't do it at a crazy pace either. And, you know, that they deliver on their stated numbers. Yeah, it's impressive that they're able to go from 50% basically in that range, supply from China down to mid-single digit percentage of their production will happen there over, you know, just over a year period. Again, that is an impressively nimble supply chain that they're able to rely upon, which, you know, should there be further tariffs at some point, they can move around and shift that around. Mm-hmm. It is impressive they're able to do that. And it certainly, you know, bodes well for their growth over the long term. It is, like Aaron said, it's such a difficult sector, retail, to stay ahead of trends, to, you know, Canada Goose may be making a great product, but if people suddenly say, you know, I don't want to be seen in Canada Goose anymore, like, it doesn't matter. You know, the trend goes against you and you're moving out. And one of the things that Aritzia has been able to do is it's not just the Aritzia brand. They have several brands in-house that they have under that brand. So, I mean, there's still, if everybody said, I can't shop at Aritzia anymore, you know, you have to be careful. You have to stay nimble, but they've done a good job of that over time. And, you know, you saw those valuations, despite the fact the stock is up, you know, just under 300% in 6 years. It's not crazy valuations. And in this, if we were outside of a tariff environment, either the stock trades significantly higher already, or, you know, it might be a buy if you're looking at, you know, 2 years out at trading at 18 times earnings and growing beyond that in terms of earnings. Mm-hmm. Interesting company to watch.
One thing as well, like, this is so anecdotal, but when we were when we were in Vegas, I guess 2 weeks ago now, we were walking through Caesar's Palace, and, you know, there's a big Aritzia store right there. And, like, I think we, like, walked around the corner basically, and then there was a Lululemon that was, you know, popping up right around the corner, where it was, like, you know, popping up for, I think it was like winter, you know, 2025 or something along those lines. Again, not that you can read anything into that, but I just think that, yeah, they've just done well with, you know, placing their stores. And I mean, it shows with the same store traffic and just the net store openings that, you know, they've been, you know, big.
And I did note the Aritzia was busy, so that's
exactly
thing, right? So
yeah,
you always, it's funny. I'm always looking every time we go past. Is it? Yeah, it's busy.
Yeah.
Maybe if I go by and they're all empty, then it'd be a
sure.
time to get the hell away from Aritzia. But they, they every time I go near them, my wallet gets drained. So I know that there's some kind of they're doing something right.
Yeah.
All right. So we're going to move on, and Aaron's going to take a look at Parkland, who had a takeover bid come in.
Yes, great. Thank you, Ryan. You're right. The company did have a takeover bid come in. It's kind of an unusual situation. I'm going to get into that. But so just to start off here, Parkland Fuels, this is a company that we've had under coverage in our income research for several years. Symbol is PKI. Trading right now at $38 per share, $6.7 billion market cap company, and it is paying a yield right now of 4%. So what they are is they're a fuel distributor and retailer. They have operations in 25 countries, but primarily in North America. This includes 4,000 retail and commercial fuel distribution stations, like gas stations, as well as commercial fuel distribution. They also own the refinery in Burnaby. More recently, the company's expanded its operations into other areas like convenience stores and even into the EV charging space. So as I said, we do have coverage on Parkland going back to 2013 when we originally recommended the company in July at a price of $17.25. So over this period of time, the share price has moved up a bit, but this company has been a consistent payer of the dividend, as well as been growing the dividend fairly consistently for the past 6 to 7 years. So if we were to look at all of the accumulated dividends that the company has paid since our original recommendation in 2013, they add up today to $18.44. That's compared to the original recommendation price of $17.25. So an example of a company where over a period of time, yes, this was about 12 years, but over this period of time, the company's consistently paid out a dividend, grown that dividend in most years, and now investors have basically been returned their entire initial investment, and they still own a company that's paying a nice yield. But it's not really been sunny days for Parkland recently, at least with respect to a dispute with its largest shareholder, Simpson Oil. Simpson Oil owns 19.8% of the company, and they've been aggressively challenging Parkland's board and management for their governance practices over the past couple of years here. Essentially, they're saying that they think that the company has produced lackluster performance. They think that a good part of the reason for this is that the company has not been focused on its core competencies, which is just the fuel distribution business, that they've gone too far out of that into other areas, other markets. And that's part of the reason why they haven't delivered a better share price return. On May 6th, which was tomorrow, the company did have its AGM scheduled, and Simpson Oil had 9 nominees to essentially take control of the board. And that vote was scheduled to take place tomorrow. Simpson had recently, just a couple of days ago, issued a news release indicating that they've received 60% support for their slate of directors, essentially meaning that they were saying that they had enough support to take over control of the board. Now, Parkland's CEO did recently announce that he's stepping down, and they're going to be looking for a new CEO. So really, this is a situation where the company has largely been in chaos for the past couple of quarters dealing with this internally. But just today on May 5th, Parkland announced that they had received an acquisition offer from a company, Sunoco, which would be for a transaction value of approximately $9.1 billion US. So Parkland shareholders could elect to take cash and a portion of the acquirer's units, or they could just take a $44 Canadian cash per share offer. Parkland then canceled the AGM, which was scheduled for May 6th, and then rescheduled it for June 24th to align with the shareholder vote on the proposed acquisition. So this infuriated Simpson Oil. They criticized Parkland's decision to advance this acquisition before having the timely shareholder vote at the AGM. Simpson is claiming that this is a clear breach of fiduciary duty. And they have also filed an action with the courts, essentially to force the company to have that AGM either on May 6th or as soon as possible. And they reiterated that they have support from over 60% of shareholders to elect their slate of directors. Now, so when we look at this acquisition, as I'd said, it's 9.1 billion US. You could also take a 44 Canadian cash offer. Now, if we look at the company's guidance for 2025, the midpoint of guidance, they're looking for adjusted EBITDA of about $2 billion. So when we look at the valuation here, on an EV to EBITDA basis, you'd be looking at a valuation of about 6.2 times. So I would say that that's not ridiculously cheap, but that's certainly not what we would consider to be a premium valuation. It looks relatively low. Maybe you could say that fair value would be around the 7 to 8 times EBITDA. I really think that it's pretty much in terms of a valuation you can justify. You couldn't justify anything lower than that. Now, if we look at the distributable cash flow for 2024, they reported $3.19 per share in distributable cash flow. That would be a valuation price to free cash flow about 14 times. So this is a valuation. It's not ridiculously low, but it looks to be needlessly cheap given the company's assets. I mean, they do have strong free cash flow. There is some fluctuation in the financial performance. However, the free cash flow has always been strong at supporting the dividend, supporting dividend growth. They have assets which we would consider to be essential. So we would think that in an acquisition scenario, it would warrant a higher valuation than this. Now, even if you just look at the share price performance over the last year, you can see you only have to go back to the beginning of 2024, and the stock price actually traded above the $44 cash offer. And another thing that I'll note is the stock price now, roughly around $39, isn't hitting that $44 offer. Typically when there is an acquisition offer for a company that is supported unanimously by the current board, you would see the share price move up more or less in line. But this isn't happening. And I think the reason for that is all the drama associated with this, the canceling of the AGM, Simpson Oil disputing this. There could also potentially be some regulatory hurdles in terms of the acquisition. So this may really just be the market saying that they're not utterly convinced that this acquisition is actually going to take place. So what is our take on this? Well, we think that the acquisition offer is low on a valuation basis. We think that they could do better than that. If not, there may be other opportunities to sell off pieces of the business, as I believe Simpson Oil wants to do, and then focus on the core business. We do agree with Simpson that it's highly questionable and inappropriate for the company to cancel the AGM a day before it was supposed to happen. And announcing this deal a day before the AGM was supposed to happen. That's very suspect. We think that in many ways, the $44 cash offer is cheap. You're really not getting much of a premium for the quality of the assets. Yet at the same time, there just seems to be a lot of commotion and drama associated with this. So some investors may wish to just cash in on that $44 offer and then look at other companies for the future. But for now, really, there's not much to do. We would just wait and see if Simpson is successful in forcing the AGM to happen and essentially what happens next. If the market becomes confident that the acquisition will actually go through, you'll probably see the market price move up closer to the 44, maybe not all the way there. But for right now, we just essentially have to see what's going to happen over the next week here or two, and we will be updating our clients on what we think the best course of action is to take.
Excellent. Yeah. And our clients can look for that update over the next week to 10 days on the company. And then we'll have our full rating on it and whether or not we want to likely take that offer or if we're waiting. There are times we've had companies, many in the past get a takeover bid and we don't think it's a good enough offer, and then we'll wait for a secondary offer. And we've had that happen. I recall a situation where you had a company receive 2 subsequent bids prior to the initial, and it kept stepping up. But if it looks like a fair bid, sometimes we'll just take the money at that price. But there are times when you can see it is a kind of like a stink bid, and there's the potential. And if the company has like a go to market, or sorry, like a 30-day go shop period, you're going to wait through that period if they have that within the deal. All right, you guys have any more comments, or should we move to Brennan?
We're good.
Okay, great. Brennan's going to take a look at Atlas Engineered Products. We've interviewed management of this company in the past. We've also talked about them on the podcast. Interesting business. Have continued to kind of not stay away from it, but just monitor it from the sidelines to see if there is an inflection point in the business. And right now, Brendan's going to take a look at with the share price down roughly 40 plus. I think it's 40+% on the year. See if there is some value today.
Yeah. So I thought that I would do an update on Atlas Engineered Products, as I'm currently writing an article on what Canadian industries may provide pockets of strength to investors under Prime Minister Carney's Liberal platform. And Atlas could be a name to benefit from increased residential infrastructure spending. So I thought that I would touch on the business, but keep an eye out for that article, as it will address other sectors as well. And the poll on YouTube that we published this week will pose the question of which Canadian industries could benefit the most from the new Prime Minister's policies. So please vote in that as well. So to get into it, Atlas Engineered Products, AEP, on the TSX Venture, currently trading at a price of 75 cents and about a $52 million market cap. And they design, manufacture, and sell engineered roof trusses, floor trusses, and wall panels, and distribute engineered wood products for use by builders of residential and commercial wood-framed buildings. Like Ryan said, we've covered the stock on the podcast several times, with Ryan covering them last in December of 2024. So considering they posted their Q4 2024 financial results on April 25th, which was just a couple weeks ago, while the stock continues to trade lower, let's dig into the numbers here. So jumping right into the financials, Q4 of 2024, revenue increased 6% to $15.1 million due to a number of large multifamily projects starting in the quarter, and sales increased due to projects moving forward as the interest rates had been declining, which was starting to result in an increase in orders. But there was also a large multifamily project which began in the quarter as well. Gross margin for the 3 months ended December 31st, 2024 was 24%, which is higher than the gross margin of 21% for Q4 of 2023. And the gross margins increased due to the project pricing for materials that were obtained for the large multifamily job. Adjusted EBITDA was down 45% to $2.1 million, which is an adjusted EBITDA margin of about 14% compared to 27% for Q4 of 2023. And these decreases were mainly due to the decrease in net income, resulting from a more competitive market for sales and increased costs related to future sales and robotic plans that required significant expansion in sales teams, management, and support staff. Now, this similar case with net loss here for the quarter was a loss of $212,000 or 1 cent per share, compared to a gain of $519,000 or 1 cent per share in Q4 of 2023. And again, the decline is related to the impacts that I noted for above the adjusted EBITDA. But I'll also note the company recognized an impairment loss of $1.5 million due to the write-off of the vendor deposit with its previous automation partner, House of Design. And the deposit was deemed uncertain as to the recoverability due to the vendor's lack of communication and closing of the business. But the company as in Atlas, has begun legal proceeding to try to recoup some of the money. So there could potentially be a benefit in a future period if they do recoup some of this money. But overall, it is a bad look for Atlas. Realistically, they should be doing more research into, who they're making deposits with and if these companies can actually deliver. Now, the balance sheet remains healthy with $13.2 million in cash, with $24.6 million in debt and leases, providing a net debt position of about $11.4 million. And the company has a trailing net debt to EBITDA multiple of about 1.34 times, which is reasonable. And as I noted last time I covered the stock, they did do a private placement last spring to help bolster the balance sheet while they make capital expansions through robotics. So you can see the issued shares increasing to about 70 million now. And just looking at the outlook, I won't read this whole thing, but management indicates that they continue to work on improved operating utilization and technology to enhance the company's performance. 2024 was a more competitive year as interest rates had risen, but was beginning to experience an increase in quoting by the end of the year as interest rates were declining. Now, the company anticipates 2025 will continue to be a more competitive market despite the interest rate reductions due to the current political landscape, and implemented tariffs are anticipated to impact businesses and consumers across North America. The company does continue to assess M&A opportunities, like its acquisition of LCF in 2023, and announced that another one had completed the due diligence phase with anticipated closing in early spring of 2025. Looking at the forward valuations on the company, last time when Ryan covered the stock when it was trading at $1.22 back in December of 2024, analysts were expecting about 5 cents in adjusted earnings per share for fiscal year 2025, which equated to a forward PE multiple of about 23 times. But following the Q4 results posted in April, analysts have been dragging these EPS estimates lower from 5 cents now down to about 4 cents as at the time of recording this podcast. And the anticipated inflection year of fiscal year 2026, when Atlas brings on its robotics in a more meaningful fashion, down from a whopping 14 cents consensus back in December of 2024, now down to just 5 cents for the year, equating to a forward PE of 14.7 times. So these revisions are likely taking into account the overall competitive quoting environment, tariff uncertainty, and the delays of the robotics at LCF and High Tech, which Ryan briefly mentioned when we did them on the podcast last in December. So to conclude here, in reference to Atlas, we believe that it is an intriguing business, and I do like the potential play on the housing sector in Canada, given the lack of supply. But it does remain a competitive market, as indicated by management's outlook, and tariffs pose a risk for the housing market in Canada and the overall Canadian economy. Fundamentally, the business does still remain pricey on trailing numbers, as it's got negative EPS for fiscal year 2024. But if over the next couple of years it can fulfill its capacity enhancements and lower costs, the forward financials and valuation multiples appear much better. But it's starting to become harder to trust these estimates that are out there, as we've seen continual revisions lower. There's tariff uncertainty, and costs are elevated as well, as they've been investing in their sales team. So at this point, I remain hesitant at this time. The business is investing for capacity in the face of potential headwinds, including those tariffs. They also recorded that impairment of $1.5 million with a robotics vendor, which is not a good look. And realistically, I wouldn't say that the business is necessarily cheap, even after its recent decline in price. So overall, I think that Atlas is intriguing, but it just makes sense, it makes sense to us, why the stock has been declining, and we continue to monitor the business at this time. And I'd like to say that, the drop in the share price, it just really doesn't come as a huge surprise. The stock price was continuing to trend higher in 2024, despite weaker earnings and headwinds in the Canadian housing sector, which I wrote back in October 2024. The stock continuing to hold its ground at that time was likely due to the enthusiasm around the business robotics investments, and that general significant inflection in profitability forecasted a few years out, which we're seeing maybe be even pushed further into 2027 or 2028, as they bring on these robotics investments. And last but not least, we just for disclosure, we do not own or have a relationship with the company.
Yeah, I think it's a good summary on the business. Brennan had said, 2023, they had better numbers in terms of earnings, although down from peak earnings in the previous year. And then earnings through 2024 continued to be very spotty, like a cent in a quarter, then a negative quarter, not high earnings in that year. And despite this, the share price moved steadily higher in 2024 and even to start 2025. The valuations on a trailing basis, and given the fact that, you're facing tougher conditions in the Canadian market in the near term, didn't seem to make sense to us. It's not that we don't like the business or like the long-term plan here, but the valuations were out of sync with the current environment, and for a cyclical business. This is a cyclical business. You're not going to I mean, it's not really an argument to be made for a construction-based business such as this. It is a cyclical business. You've also seen this company fund itself through issuing shares. If you go back to, I think it's 2017, 17.3 million shares out today, 65 fully diluted in the range of 70 million. So that's, significant increase in shares, and you're fighting against that to produce EPS. So, you have to have significantly higher revenues. And again, analysts, even the analysts who are on the side of the business that would love this company to do financings with them, are bringing down their earnings estimates to the point where, this year you're looking at a loss of 2 cents plus per share. And then maybe, in an optimistic scenario in 2024, 2 cents positive, 2 to 5 cents. I think Brennan brought up the earnings, but those have been coming down. If it was 2 cents and you put it at stocks, 75 cents today?
Correct.
That's a high PE looking 2 years out. So again, this is a business we follow. Perhaps it could be a recommendation at some point, but we'd have to see a turn, a catalyst here, and then we may get it at a cheaper price. Again, interviewed management, they seemed reasonable, but are the valuations where we like to see to give us the margin of safety that we want, particularly in a company like this? Not at this stage, and we continue to monitor it.
Yeah, exactly. Like, I think, and that's the thing where, we're trying to actually see a little bit of a confirmation of the inflection in the numbers, before we're going to put our hard-earned dollars. And again, you can come down to the point where people always say, oh, but you're missing out on the opportunity getting in early. Well, look if, someone was getting in, at $1.40, I was even covering the stock. Just there's risk that, there's delays or, costs go up, et cetera, et cetera, et cetera. It's cyclical, as Ryan had mentioned. The risk isn't, it's not gone. It's a risky name, in the space. And, clearly, with these EPS revisions downward, it's the numbers aren't confirming, that, these robotics investments and, the inflection in earnings have, are taking place, I guess, at this point. Like, we need to wait for that to see.
Yeah, and there's always competition for your dollars. Do we find another company that's trading at more reasonable price with growth ahead of it? I mean, I'll give you an example. We had a company in our coverage go up 15, 16% today alone. Somebody recommended them on BNN. This is a company we recommended 10 months ago at like 80 cents, 78 cents, and it trades at $2 today. Well, its current trailing PE is below 10, and we expect growth this year. So you put that PE towards Atlas. Atlas is 35 times a year out earnings, not just this year, like a year, like 18 months forward. So you're paying a premium price relative. You're also in a less cyclical industry in the business that I'm talking about. So there's always what else can we do with our dollars? And if we can find a company, and again, that company is now probably up 160% over the past 10 months. And it still trades at more reasonable valuations, has a better balance sheet, and actually has growth forecasted for this year. So, I mean, you're always competing with another small cap. That small cap would get our dollars over this business right now. Doesn't mean that Atlas is a terrible business. We just have to see what is a better place to put our capital. And there are other places where we see better valuations, more certainty of growth, less cyclical industry. So that's where we put our dollars right now. All right. I think that will conclude that segment. Brett, you have you're looking at the Trump tariffs, the impact they have on the general economy, and what you could see going in, at least in the near term, going forward.
Yeah. So I really want to do this just because there's been a few things that have come out. We've had GDP come out. We have some like ports data, stuff like that. And it's really just to see how the economy is really reacting as a whole to the Trump tariffs, because you're going to see certain effects come in and out over the next, especially month, and people are going to be freaking out. You're going to have headline numbers. You're going to have great results the next month because they're going to have these fluctuations that just reverberate through the economy. So I really just want to go through what we can really see in the economy right now and what may occur in the near future. So last week, we got advanced US Q1 2025 GDP numbers, and GDP for the country fell by 0.3%. This was driven by actually a massive surge in imports as companies really tried to front-run tariffs. The chart I have up right now, you can just see the bar for imports is just huge. It outweighs everything else by a significant amount. Imports grew by 5% year over year. So GDP just, if you're taking the expenditure side, which is how you normally calculate GDP, it's consumer spending plus investment, or consumption, I should say, which is consumer spending, investment plus government spending plus net exports, which is just exports minus imports. So the much higher imports, it lowers GDP. It's a negative impact, which is why you just get that contractionary effect in the overall GDP. If you are just seeing GDP fell by this, it's the rest of the economy was doing fine, and actually imports really brought it down. And this is what I mean by you're starting to see some of these effects just trickle through the American economy, even in just the numbers. And as well as I will say is this impact is actually normally temporary. As imports flow into companies' inventory and then they're sold off, that will appear in consumption, which will appear in future GDP, which will prop up future GDP to a degree, assuming you can sell the inventory you brought in. As well, I will mention here, these are advanced GDP numbers, which do get revised to first preliminary numbers and then final numbers in the next couple of months. And during times of stress and just uncertainty, the revisions can be greater. When you look at recessions, normally the revisions are greater, especially on the downside. So whether or not we do see that happen here, that's the question, if we do see future revisions, because as I think Aaron had a couple weeks ago, he showed the Atlanta Fed GDP now, which we can look at now. Just this is for Q2. But at the time, it was something like 2.5% negative for Q1. And obviously that wasn't the case. But Atlanta Fed GDP is a bit different as well, because they're looking at more active. But the point is GDP gets revised as more information comes in. So if you look at the Q2 GDP, it's now expected growth of 1.1%. This is a continuation of that general slowdown we have been seeing over the past really year or so, but it's just not the same degree as that headline minus 0.3% number we saw in Q1, because we're not having those massive surge of imports anymore now that tariffs have came in. The US did have some early impacts of tariffs in March against steel, aluminum, and auto, but it wasn't until the so-called Liberation Day, which we really saw broad tariffs implemented, and that really hurt the entire or really surged the degree of tariffs as a whole. And then we saw just really the following week, the tit for tat, and then Chinese tariffs are up at 145%. So likely moving into the next quarter, we're going to see actually the opposite impact from the import-export dynamics. Since we saw all that front running of tariffs, imports being heightened, we'd likely see it lower. Even if tariffs just disappeared, you're going to have heightened inventory right now, which means in coming quarters, you would naturally have less imports, even if all the tariffs went away. But coupled with that increased tariffs, you're going to have significantly lower demand, particularly for Chinese products and goods, as the costs have surged with the 145% tariffs. You might not see, with tariffs, you have to remember, it might not be the entire product. For some things, it might be the finished product, which you probably see 145% pass through. But in some cases, it might just be a component. It might be 1%, 2%, 3% of a company's cost, and they might take that on. They might raise their products by only a few percent to offset the tariffs. It depends on the product and the end market, of course. So it's not 145% across the board by any means. Like, I've seen some people misrepresent the import tariffs. It's not to that degree. Further, though, the U.S. has removed the de minimis exempted packages, which declared under, if you had a package under $800 of declared value, which I will tell you now, a significant amount of importers did just lie on their custom forms as well. So then they didn't have to pay any duty. So companies like Temu, Shein, those Chinese low-cost companies took full advantage of this. And in the chart I have up, you can actually see a massive surge in low-value packages over the past decade. The small packages will now be subject to a 120% fee, or a flat rate of $100, which they're actually going to further increase to $200 flat rate on June 1st. And I just want to really contrast that into in comparison to just US imports at total value over the past decade, you can see it's really been plateaued year to year. There's some volatility, but the overall dollar value of imports is more or less plateaued. Contrast to the surge in volume in low valued packages. This change alone, excluding all the tariffs and everything else, could have structural change to the US-China trade relations, as you just have really had such an emphasis on these low dollar packages. Overall, we will see a drop in demand for Chinese products into the US. JP Morgan is expecting a 75 to 80% drop in shipping from China into the US in the second half of the year. So that is a massive drop in imports in the second half of the year. And it will have really effects across not just the US, but the world economy, as you do have those effects really start to spread out past there once you have the run-on effect of various economic impacts. And the one thing we can start to look at is ports, because they can be really seen as a forward-looking data point and just how they will result in the impact on the US and the drop in shipping will have on the US. So looking at the largest port in the US, LA and Long Beach, shipping takes about 2 to 3 weeks to travel from China to the west coast of the US. So we've really had that delay. You can think about it, we're about 3 weeks out from the really big uptick in the Chinese tariffs. So now we're just starting to see this week the actual impact of tariffs at US ports. Because once it's on the boat, or once it's declared to go on the boat, I can't remember which, I think it's once it's declared to, then you're locked in out of that tariff. So if you're in that 1 day period where they're at 45%, by the time it got to the US, which would be around now, you're only paying 45%, not 145%. So we're just seeing that impact just now hitting US ports. You have a drop of 35% year over year at the port. And just to give you an idea, Chinese imports for the port of LA and Long Beach is about 45% of the activity at the port. Was it all of it? No. But a lot of it, yes. If you compare that to the prior week, that's a 16% drop week over week, as you obviously do have fluctuations on a weekly basis as well as a yearly basis. Next week is expected to fall 11% year over year, with the following week rising 65% year over year, which might be, why is it rising? Well, that's because likely many of those shipments are actually going to be canceled, or the port is going to be skipped, otherwise known as blank sailing. Assuming no shifts in tariffs or the de minimis rules, this likely is going to not create an empty port like I've seen some YouTube videos and social media posts claimed, but it is a clear slowdown of port activity. You're probably going to see, like I was saying, a drop in that 65% increase is probably going to end up going negative as well, in my opinion. But we'll have to see how that works out. Because even when I looked last week for the week 20, the May 11th to 17th, that number was actually higher as well. So we'll see how that ends up in the next week or so. So what does this actually mean? In the coming days and weeks, they'll likely actually start to see a real impact in the US economy, as there'll be a slowdown in trucking and port worker hours as imports fall. The LA port is significantly automated, so the worker hours is a lesser degree than it used to be. But really what you're going to see is trucking will likely be impacted significantly. As imports fall, fewer products are needing to be moved across the country. This will just overall drop the degree of trucking across the country. This will result in heightened unemployment within the industry and weaker fundamentals for companies within the industry. So if you are invested in a trucking company, Q2 will probably be quite a bit weaker than Q1. That's not unexpected. This will be really what I would call the start of the real world impact of tariffs. We've seen the financial markets react and various commodities change. We've seen gold skyrocket, but we're starting to see an impact on what will likely be employment in the next month or so. Next, as the built-up inventory gets moved through the US, consumers will start to see either higher prices or fewer products on the shelves, likely a very big combination. For instance, instead of like 10 types of blue shirts, you might only see 5 types and at a higher price, as they're manufactured in the US or Cambodia or Vietnam right now, and not in China. And this will start to happen likely over the next few weeks as the shipments move throughout the US into later May, early June, sometime around that, depending on the inventory on hand and the degree of reliance on imports for the industry. Larger retailers might be able to absorb the cost for a bit, but then they'll end up passing them through eventually. But small businesses in particular, as they can't absorb the costs as easily, they'll probably likely look to pass on a cost at a quicker rate. But for some companies, they may have months of inventory on hand, allowing them to shift their supply chains out of China into whatever lower tariff jurisdictions. But obviously, we have a bit of uncertainty there, to say the least. But generally, just as a whole, this will put upward pressure on inflation within the US in the second quarter. And as far as financial markets go, as they digest these new factors and as we progress through all the uncertainty and how the actual real economy adjusts, we'll likely see an uptick in volatility, in my opinion. We've seen a period of reprieve with the broad market recovery. But if there is no change of pace and the policies remain erratic, volatility will likely come back. We've had a good few weeks. If you do start to see bad news hitting the headlines again, you're probably have volatility. That leads us to really the next big question, is whether we actually see a pullback on tariffs after this 90-day pause on really every country but the US, or but China with the US. So we saw the 90-day pause after Trump's initial board of tariffs on the left there. And he pulled back to effectively every country but China to 10%. And that will run out on July 8th if you're actioning by 90 days. If we don't have trade deals being announced by then, the real world impacts will likely be exacerbated. People will start to panic again. We saw that the following week after those tariffs were announced, people and financial markets really got scared. You saw VIX spike right up. You saw volatility really increase. But of course, with Trump, things can shift at a moment's notice. Trump just announced a 100% tariff on foreign films for national security purposes. I'm not sure how national security comes in there. I think Trump just might want to be in another Home Alone, but that's just my speculation. That's what he's aiming for. But the general instability just exacerbates these negative impacts of tariffs, as you really can have these whiplash effects. Because right now, even if tariffs are removed, why I'm focused on ports is you are still going to be really missing at this point 3 weeks of shipments. That inventory is not coming to the US. It has gone somewhere else or stayed in China. You will have that 3-week gap. Yes, there is a heightened level of inventory right now, but the longer this goes on, the more of a really whiplash effect we'll see in supply chains. And we can see something like COVID, where we have this period of oversupply, undersupply, and then you have people panicking buying toilet paper. That isn't shipped from China. That's mostly US production for the US, but I would not be exactly surprised if we did see another run on toilet paper. But companies and financial markets really like a clear policy, and we just don't have that here. It doesn't matter if it's even negative, preferably positive, but even if it's negative, financial markets would rather have a clear line of sight, and that's just not something that has happened here. And what one possibility, which I'll end my segment on, is just more of an open question, is do we just see tariff pauses? Do we see the end of the 90 days and then he goes, oh, it's 180 days now? Do we just see him just slowly push this out? Because that's what I'm starting to lean towards. Or do we actually see a set policy going forward? That is really the question which I'll be looking towards at this time.
Yeah, very interesting. And I do like the picture from Home Alone there. That is a great picture.
One thing that I'd like to bring up too is, we spoke with we spoke with a company last week, the CEO, and he ended up getting a contract from China, and they do manufacturing in the US, and it's forcing him to make the decision of do some contract manufacturing in Europe, for example, or actually buying the capital equipment in Europe and setting it up himself, to basically do the manufacturing there rather than in the US.
Yeah.
So
it's severe irony, right? Because
yeah.
like the policy, the tariffs were put in place to increase U.S. manufacturing, and this is a company. It's a small part of the business, but they're manufacturing in the U.S. a material that is then sold to China. And because of the reciprocal or the tariffs that were put on by China from U.S. goods going in, now that order, it was $1 million order, not massive for the business, but not nothing. It is now canceled in the near term, kind of on hold, but canceled. And to get around that, the business that was manufacturing for years in the U.S. now is looking to move to Europe, manufacture there, and sell the same items to China because they will get around that tariff. So the exact opposite is actually occurring. Again, this is anecdotal in one business. It's a great point that Brennan brings up, but it's ironically the exact opposite of the intended policy is occurring potentially with that company.
Yeah, it really as a whole just makes capital allocation for a business impossible to do. And that's what I mean with companies can deal with negative or positive impacts. It's hard to deal with uncertainty.
Yeah, and part of it there is this company, this CEO is looking at it and saying it's more stable to manufacture likely out of Europe because we have a low degree of likelihood that you're going to get that type of tariff put on those European goods going into China. So they may make, it's still in the decision making process, but it looks like it could go forward. They may make that decision to move manufacturing from the US, not bring more in so they can ship to China without that tariff. Yeah. It's unintended consequences, but I mean, you had to think that if you're going to put those aggressive tariffs on China, China is going to do something back on your goods that are going towards China. And now that they have, and you're seen as being a volatile nation tariff wise, do people consider moving out and moving to another jurisdiction and shipping to China?
Yeah. One of Trump's advisor, Bessent, actually came today saying something along the lines of can still invest in the US. It's still the great premier place to invest in the world, where other analysts are saying that US brand is tarnished. And that's really the trade-off.
It's all about certainty, and the power of the dollar has been about stability, and you rock that. And like, this is again an unintended consequence, but we're hearing directly from a CEO, not the biggest company in the world, but you're talking about one order from them that is $1 million. They're employing people to manufacture in the US and now considering moving that because China has a tariff. And of course, the administration in the US, I guess, could say, well, remove that tariff, and then it won't. Well, I mean, then they're going to say, remove the tariffs on us. And that's the uncertainty. And they're not getting that uncertainty if they manufacture that same product in Europe.
Yeah.
So it is interesting. It is interesting when you get that level of commentary from a business that's dealing with the day-to-day of these policies, and they're making a move that is counter to what at least is stated to be intended. Right? The stated intent.
Yeah.
All right. I think that's going to end off our show for this week. If you are watching this on YouTube, remember to smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.